Hello and welcome to this week's ITPM Flash. My name's Shek, it's great to be here. And today I'm going to outline why I'm adding a rotation trade to my portfolio. And when I say rotation, I do mean rotating out of one of the outperforming high performers and into an underperforming value stock. But I'm going to have to expand, obviously. Now, first point. Is this sort of rotation happening now? And the answer is unequivocally no. We're still in a two-tier market. We've got the hyperscalers and 20 or so obvious AI winners doing great, and the rest of the market isn't. And of course, we know that the indices are at their all-time high, the weighting effect. And then we also know that there's $6 trillion in the money market accounts. And as the markets continue to trade at or near their all-time high, or I mean the major indices, that fear of missing out kicks in and it can puff in more money. If that happens, we're going to have the big melt up, liquidity driven. But when you look at this chart, you'll see that we're not there yet. We've been talking about the broadening out for a long time, but if you look at this chart just showing the Nasdaq index up 18%, the equal weighted Nasdaq's only up 5%. And the picture's no different when we look at the S&P. Okay? Equal weighted only up 4% and the indices at or near all-time highs, big bull market up 15%. And we have to come to our poor little Russell index, trying to rally still, but not really. So for 2,000 US-centric companies, there isn't a profits bull market at all. And a lot of these stocks aren't going anywhere. So we can safely say that it's a two-tier market and rotation's not happening, which begs the question, why am I thinking of this trade now? Is it because we've had a little correction in Nvidia, a 3-day sell-off? Of course not. But it is a timely reminder that these are highly valued, and rightly so, momentum stocks where everyone's long, and we think Nvidia is going to 200 with a high price target. We think the S&P is going to 6,000. And just a little reminder, okay, that it's not a one-way bet. But that's not the real reason of the rotation. I know that people don't sell stocks because the charts look aggressive. They don't sell stocks because the valuations are too high. They need a reason to. Is this trade going on because inflation's proving stickier and the economy's slowing and we can argue about a bit of stagflation and all that sort of thing? Yeah, a little bit, but not really. So what's the reason? I'll show you. As we've come out of Q1 numbers, have a look at forecasted earnings for the Magnificent Seven and the rest of the S&P. And you're all aware that we've been told earnings have been really great. Well, they have for 7 companies. If you strip out them, Q1 earnings growth was negative. When we look forward at Q2, you'll see that the Mag 7 is still going to grow their earnings 29%, which is obviously a lot more than 5.6% for the average for the rest of the S&P. But we trade rates of change, not absolute numbers. So I'm putting this type of trade on, not because I think the big winners are not going to be putting in the biggest revenue growth, the biggest earnings growth, because they are. What I'm saying is their valuation reflects that, and now the rates of change are moving more into favour of the remaining S&P 500 companies. 28.5, 16.6, 18.11 by Q4, and the obvious caveat is these are consensus year-end numbers, right? There's a lot of reasons why all of these numbers are too high, but the rates of change in earnings growth support the rotation trade. So that's the main reason. It's not happening now. Why am I looking at it? Couple of anecdotal pieces of evidence, but quant-based in the end. The numbers are turning. Now, I'm clearly not saying that people are going to sell all their Nvidia and buy some other bombed out rubbish. Of course not. But when you think how many hundreds of billions of dollars of paper profits there are, the sheer position size of all the Magnificent Seven, I don't need a big rotation out of 50% into, the rest of the market. We're talking top slicing. And what that means is account managers take 5 or 10% of their holdings off, and that's a very big number. And sure, you can sell $200 million of Nvidia in a day. You can't buy $200 million of an awful lot of stocks in a day. And if rotation happens, it won't be 1 or 2 managers doing it. It will be several hundred. It will all be happening at the same time. And when we spot liquidity flows changing, things can move very quickly. So am I calling the top of the AI trade and hardware? No. Am I calling the top of the earnings leadership, the EPS growth? No. I'm saying it looks to me like the probability of top slicing is increasing, and it's based on the earnings projections for the non-leadership. That's why. And it's funny, when we think of FedEx results, they've gone up 15% after earnings. It's also anecdotal evidence to me why I want to put this trade on. What do I mean by that? Well, I mean FedEx is up 15%. Great. Management take a bow. They are managing this company brilliantly. And there's the prospect of realistic, more efficiencies to come. And all these big logistics companies will have a good AI tailwind as all these apps get embedded into the operations just through the sheer scale. And the stock's up 15%. What FedEx isn't saying is our end market's really good, volumes are good, pricings are good, a more sequential demand-driven earnings recovery. They're just saying we're taking costs out everywhere, we are more efficient. But the market is really rewarding these underperforming companies that show signs of an improvement. Not an earnings growth trajectory of Nvidia, but an improvement off a low base. So it's like a general broadening out, but I'm expressing it as a pair. Now, the controversy of Target versus Arista Networks. This is not a typical ITPM, long and short. Why? Target's massive. Arista Networks got okay quants trading really high. So it's not a typical trade, but this is one position in my book of 12. Remember, all of these ideas are not necessarily standalone trades. They're within the context of my portfolio. But what I'm not doing is looking for something that's up and selling it and looking for something that's down and buying it. The profile of the graphs are like that, but I need a couple of fundamental reasons why Arista Networks might sell off after next earnings and why Target might rally. So when I think of Target, it's in a really good sector. They've just had an awful year and a half executing. So Walmart's doing great, Costco's doing great, middle income, lower middle and lower struggling. They are going to places like Walmart if they hadn't. And people with low income are staying in these sort of stores. So I think there is a good sector tailwind for the sector, and Target's the big underperformer. And despite the problems of the year, I feel that they will turn it around. They're doing little deals with Shopify. They've already mentioned that AI is going to boost their efficiencies. Now, that will be true at Walmart and Costco, but remember, this is bombed out, a few signs of green shoots, and the stock can re-rate. Arista Networks, they've been upgrades this week, $400 price target, stock at $350 as I speak today. Analyst buy recommendations, not a classic ITPM short. So what's my fundamental reason for justifying this? Well, it might be Nvidia's getting into networking. There might be a moat issue. The valuation, which is the least important part of this whole trade, is quite rich. And I mean, revenue growth 15, earnings growth 15 for the next couple of years is okay. It's not amazing. It's trading on 15 times sales. And I think the rates of growth will be in this sort of range. It's normalizing. They've had a couple of years of massive revenue and earnings growth, and now it's sort of plateauing. But of course, the stock's much higher and the valuation's richer. So that's the type of trade I want to put on. Would I put it all on today? Don't have to. I can wait for more signs of the rotation. I can put a half on. These are both out of the money verticals. So if you have a look at the structures, you can see because these are out of the money, I've gone a bit further out, a bit longer dated. I've got a 310, 270 spread on Arista Networks. That's me saying price to sales 11, 12. Okay? You get a 4-to-1 return. And on target, I'm looking at 20% move or so. We're going in 155, 170. Now, when we think about the risks, what happens if money pours in from the money markets, there's no recession, and we get the big melt up? Well, probably lose money on Arista. Target's got a chance. And remember, if your long leg works, you're making 4 times your money and you're only losing 1 times on the short. That works. What happens if we have a proper slowdown and we have a 10% correction? Then I'm pretty sure my Arista is going to more than cover the loss I might make on target. What happens if my fundamental reasons play out and we get rotation? Well, it's the flow of funds that's going to light a fire under this, and you can see they'll both have really good returns. And the way I lose, this market just continues in this 2-tier way. All we want are the AI winners. All we want are the numbers now that we can see now, revenue and earnings now, and we're just not interested in anything else. So there we have it. I'm adding a bit of rotation into the portfolio. I think it's time to think about it. Get a pair ready. When liquidity moves, it can move very quickly. Better be prepared now. Look for the signs that it's happening and then execute. I look forward to seeing you next time. Bye-bye.